In a matter of months, the price of oil has collapsed to its lowest level since 1999, causing oil and gas stocks to plummet, which means it's a perfect time to invest. What's up guys, my name's Adrian and welcome to my channel on passive income investing. I wanted to make a video to quickly show you the easiest, most efficient and safest way to cash in on the recent oil price crash as an income investor. It's a perfect time to invest in the energy sector right now because it hit rock bottom. Why did this happen? Well, if you haven't read the headlines lately, I'll explain it to you in 60 seconds, and after that, I will show you the easiest and safest way to invest. So to summarize, the coronavirus pandemic has caused the worst case scenario for the two variables that determine the price of oil or any other commodity for that matter. Those two variables are supply and demand. So demand has never been lower because of the global travel restrictions and the shutdown of the numerous economies around the world. Planes are not flying, people are barely driving, factories are temporarily shut down. This has literally killed the demand for oil. In terms of supply, it's also the worst case scenario because supply has never been higher. With the oil price war between Saudi Arabia and Russia and record high worldwide production levels, the world is flush with oil. So much so that we have no place to put this stuff. Articles have surfaced recently that oil producers are actually running out of space to store oil. That's how bad it is. So extremely low demand and extremely high supply equals extremely low prices. But this is a temporary situation, so we have to act quickly. Will travel restrictions be lifted? Yes. Will factories and businesses start reopening? Yes. Will people all around the world start driving their cars again? It will be a gradual process, but I think you get my point. So as passive income investors, how do we take advantage of the situation in order to earn some really nice passive income in the form of dividends? So let's be honest, the oil and gas or energy sector of the stock market is definitely not a popular sector to invest in right now. It does have a black cloud over it because of the damage fossil fuels do to our planet. We all understand that, but the truth is oil is not going away anytime soon. Another fact that people ignore or simply don't know is that the energy sector is known to provide investors with really good dividends. So what stocks should you buy? Well, to reduce your risk and maximize your diversification within the sector, your best option is to invest in an energy ETF. ETFs are great for a situation like this because they're like mutual funds and hold multiple companies in them, which means you lower your risk compared to buying individual companies. So in order to give you a few options here, I'll go over 3 ETFs that focus on the energy sector but have different characteristics. It's really up to you to decide which one you feel more comfortable with. So let's check them out in detail. Okay, so the first ETF I want to cover is called the Enhanced Income Energy ETF. The stock symbol is HEE. This is from an ETF company called Horizons, one of my favorites. So the annual management fee is 0.65%. So this ETF focuses only on the Canadian energy sector. So all the companies within this ETF are Canadian energy producers. If we go on the holdings and just look at the top 10, you'll see here that they're all Canadian, starting with Enbridge. So Enbridge, which is the largest energy company in Canada, makes up the most of this fund, which makes perfect sense, 14.5%. In terms of distributions or dividends, this ETF provides it monthly. So you can see here the amounts. And obviously they're going down. I mean, it was January, February was a little over 3 cents. March it's 2 cents, and now you could see the latest one in April just came out and it's a little under 2 cents. So this is normal because of the oil price crash. So what's the dividend yield right now? So if you open up this distributions box here, what this tells you is what your yield is if this ETF will continue to provide the most recent distribution, which is very, very, very low here. So it's actually still not bad. It's 6.10%. But the real number you want to be looking at is this one, what the average is of the last 12 months. This is the more realistic number because it takes the average of the last 12 distributions. So you could see here that buying this ETF at this price right now will pretty much give you a yield or a potential yield of 13.75% or more if oil goes a lot higher than what it used to be in the last year. So you could see, so basically what this means is if you buy it right now, you get a dividend yield of 6.10%. But if the distribution starts going up or starts going back to normal, like at 3 cents, it will look more like 13.75%. So really, really good potential here. The second ETF is called the Harvest Energy Leaders Plus Income ETF. So the stock symbol is HPF. And the annual management fee is a bit higher than the last one. It's 0.85%. They also give the dividend monthly. So if we look at the portfolio here, you have the top 10. So you could see it's the really, really big companies. You have Total, which is from France, Royal or Shell, which is Netherlands, BP, which is UK, TC, Enbridge and Suncor is Canadian. So a really good mix here, and you have really the big ones all over the world. You have the geographic breakdown here. So you could see that the main focus is in the United States, a little over 50%, and then you have the rest. You have Canada, France, Netherlands, UK, and China as well. So a really good in terms of diversification, geographically, you're getting the best or the biggest energy companies all over the world. So if you look at the distributions now, or the dividends, you could see that they are remaining relatively stable. So these guys, they, unlike the first ETF where they vary a lot, these ones tend to hold pretty steady at 3 cents for a really, really long time. Will it stay at 3 cents? Will it be reduced? It's possible, but the latest one has not come out yet. So in terms of the actual yield, if we go here and if you would buy the stock or the ETF right now, you would get a yield of 18% annually, which is just huge. So really, really good potential here. Well diversified, a little bit more focus on the US here, but this is pretty safe because you only have the really, really big players all over the world. Okay, the last ETF I want to cover is called the Energy Giants Covered Call ETF. This is from a company called CI First Asset. The stock symbol is NXF. And the annual management fee is 0.65%. These guys, however, unlike the first two, give their dividend or distribution quarterly and not monthly. So if you look at the holdings, you have 15 companies here, really the biggest players, the biggest energy companies all over the world, except in this one, there is zero exposure to the Canadian energy sector. So there's no Canadian companies here. A lot of the companies are part of the second ETF that I showed you. So really only the big guys, the big players. And if we look at the distributions real quick, you could see here that they're quarterly, and they also vary just like the first ETF. So in 2019, you could see here that the distributions are going lower and lower, which makes sense. They follow the price of oil. So at the beginning of 2019, it was 15 cents, then it went to 14, then 10, then 11. And the latest one that just came out in 2020 is a little under 10 cents. So the 12-month trailing distribution yield, or the average distribution yield, is 12.39%. So most likely, if you would buy this one at this price right now, you would be locking in a really nice dividend yield of 12.39%. So in my opinion, this is definitely the safest one out of the three, just because it only focuses on the really giant players. So to quickly summarize, guys, the first ETF, HEE, focuses purely on Canadian oil and gas companies. So you got the best ones in Canada, and the dividend is paid monthly. The second ETF, or HPF, has only the big oil and gas companies all over the world, but a significant focus in the US, 50% to be exact. This ETF also provides a monthly dividend. And the third one, NXF, focuses on an even balance of the biggest international and US companies, with zero exposure to the Canadian energy sector. This ETF, however, provides its dividend quarterly instead of monthly. So personally, in my portfolio, I hold the last two ETFs, not because I don't like Canadian energy producers, but because I own some Canadian companies individually. So with these two ETFs, I get my US and international exposure as well. All three ETFs, by the way, use the covered call option strategy, a very safe and conservative options strategy. This means that the fund manager routinely sells options on the stocks in the portfolio to boost the income that the ETF generates. So you're getting two income streams instead of one. Stream number one is the dividends from the individual companies, and stream number two are the premiums from selling options. So the covered call strategy actually works best during high volatility and market downturns. So if you want to learn more about this strategy, I'll add two links in the description below, which will take you to a short article and a YouTube video on how the covered call strategy actually works. I will also add the links to the three ETFs that I talked about so you could read up on them more yourself. So there you have it, folks. That's how you could cash in on the recent oil price crash. I personally love ETFs. They're the perfect investment vehicle to efficiently and safely invest in a specific sector of the market. It's efficient because you automatically get exposure to the best companies in the sector, and it's safe because you're not buying any individual businesses or putting all your eggs in one basket. So thanks a lot for watching, guys. I really appreciate it. Please make sure you hit the like and subscribe button, as well as the little bell next to the subscribe button, so you're alerted whenever I come out with a new video. So take care, guys, and see you next time.